Differences between single-entry system and double-entry system. Single-entry system versus double-entry system. The system of accounting in which only one-sided entry is required to record financial transactions is single-entry system. Whereas, the accounting system, in which every transaction affects two accounts simultaneously, is known as the double-entry system. The nature of single-entry system is simple and easy to maintain. Whereas, the nature of double-entry system is complex and requires proper knowledge. The type of recording is incomplete in single-entry system. Whereas, the type of recording is complete in double-entry system. The errors are hard to identify in single-entry system. Whereas, the errors are easy to locate double-entry system. The ledger are based on personal and cash account in single-entry system. Whereas, the ledger are personal, real and nominal account in double-entry system. Single-entry system are preferable for small businesses. Whereas, double-entry system are preferable for large businesses and organizations. The preparation of financial statement are difficult in single-entry system. Whereas, the preparation of financial statement are easy in double-entry system. Single-entry system is not suitable for tax purposes. Whereas, double-entry system is suitable for tax purposes. Financial position cannot be easily ascertained in single-entry system. Whereas, financial position can be easily ascertained in double-entry system. Single-entry system provides limited financial information. Whereas, double-entry system provides comprehensive financial information. Single-entry system records only cash and personal accounts. Whereas, double-entry system records all types of accounts and transactions. No trial balance or balance sheet is prepared in single-entry system. Whereas, trial balance and balance sheet are prepared in double-entry system. Single-entry system lacks internal control measures, whereas, double-entry system offers better internal control measures. Single-entry system does not conform to accounting principles. Whereas, double-entry system conforms to accounting principles. Single-entry system does not require specialized software. Whereas, double-entry system often requires specialized accounting software. Difficult to detect errors and frauds in single-entry system. Whereas, errors and frauds can be detected more easily in double-entry system. Now, let's assume you have $10,000 as cash balance at the beginning of March. And you are the owner of a small business. Here are some transactions that occurred during the whole month. On 5th March, you paid rent $3,000. On 10th March, you sold products worth $2,500 in cash. On 15 March, you bought a TV for business for $1,000 in cash. On 25th March, a customer paid an invoice for $3,200. The solution is given for idea for single-entry system. Explanation: the example, when we paid the rent, it went into the expense column and was deducted from the starting balance. Then you receive cash from selling products, which is an income. So, it was recorded as an income and added to the remaining balance. The same thing goes for the other two entries. And at the end of the month the final balance is $11,700, which is in your hand or in a bank account. Whereas. Now, let's have a look at an example of double-entry bookkeeping. Assume you are the owner of a service-oriented business. Here are the transactions that took place in April. On 3rd April, you bought a table of $150 for your office. On 7th April, you provided service to a customer for cash $1,200. On 12th April, you paid rent for $2,000. On 18th April, a customer paid $15 directly into your bank account. It was a bill dated 13th April. The solution is given for idea for double-entry system. Explanation: the example. In April 3, when the table was bought, the asset increased and cash decreased. So, the table was recorded as a debit and credited the cash. In April 7, you provided services in exchange for cash. So, the cash increased and was debited and the service account was credited. The same thing goes for the April 12 transaction of rent paid. Cash decreased so it was credited and rent was debited. April 18, the customer paid directly into the bank, so the bank balance increased and was recorded as a debit. As it was an accrued transaction, the accounts receivable decreased and got credited. In the final balance, we can see the total debit and the total credit are the same. This will always match cause that's what duality means. Kindly subscribe my YouTube channel Thesis Helper. Thanks for watching.